Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1213A, and today's date is February 24th, 2017, and the title of the episode is there a pattern when recessions and depressions occur? Let's get into the economic collapse financial news. Now, as we know, Greece, well, they have a lot of problems. The debt level is too high. They're looking to get more debt, and Tsipras is out there. And he is claiming that this new deal they're coming up with for the bailout, it's going to be fantastic because it will end austerity. We will not use austerity anymore. Well, didn't he campaign on this? Wasn't his whole campaign about not going along with the central bank, not implementing austerity on the people? That was his whole campaign. And he didn't follow through on it. Actually, he did the opposite. And Tsipras, he was speaking in Parliament, and he described the deal reached Monday as an exceptional success and said it showed the country's creditors accepted Greece's insistence that it could no longer bear further budget austerity. Well, how long do you think this new loan is going to last? It's not going to last that long until they need more. Like in 2018. And when that time comes up, as we saw going all the way back to 2009, up to this point, they need more and more and more. It will never end. And they will have to implement austerity, unless the whole system comes collapsing down. Then that's a whole nother problem. We see here in the United States, the consumer confidence, well, it has fallen for the first time since the November elections. Because what's happening right now, people are starting to realize there's something wrong with the economy. The stock market continually moves up and up and up. And if this doesn't look like a bubble, then I don't know what else looks like a bubble, because all of a sudden the market takes off and it's a straight line up. I mean, again, all indicators point to a huge bubble. And we can see that retail, it's getting worse and worse. We talked about hhgregg and how they might be closing some stores. And right now, we find out they had 14 straight quarters of declining sales. And they're looking to declare bankruptcy. And again, retail is contracting big time. And so is home sales. We talk about homes quite a bit because once the real estate market goes down, guess what? That's going to take everything else down with it. And what we're seeing right now is that new home sales, well, they completely disappoint. The census reported the latest disappointment when it comes to new home sales, missing an expectation of 571,000. And up from a 3.7% from a downward revised 535,000 in December. And the data for all three prior months, well, guess what? They were revised lower to try to push this month up. But more troubling than all of that is that 1 decade after the last housing peak, new home sales are well below half their peak hit in 2005. And when you look at this, we see housing has really gone nowhere. It's like flatlined. And what we're seeing right now is mortgage applications are declining, new home sales are declining, and existing home sales are going absolutely nowhere. And we see out in New York City that there is a major problem in the high-end condo market. Not all is well in the luxury segment in the U.S. house market. And what we see is the Manhattan's luxury condo segment, well, as we reported many reports ago, there's been a sharp deterioration in that market. And what we're seeing right now, this is coming from Barry Sternlicht, CEO of Starwood Property Trust. And just as a reminder, Starwood Property Trust isn't a traditional mortgage right plowing its capital into mortgage-backed securities, but instead, its primary business is the direct financing of a real estate project, and as such, it is far more familiar with the nuances of a given real estate market than those who transact in bulk. So, it is what Sternlicht said during yesterday's Starwood Conference. He said that the market right now is at all-time highs. That optimism is now very far removed from the one sector that has traditionally benefited the most from soaring S&P 500, Manhattan luxury real estate. And he went on to say, New York City rental market is going to be weak. He said it is weak. It's going to continue to be weak. Miami has a similar situation with a lot of condos coming online with much a different structure than any market we have seen before. The condo market at the high end is a catastrophe and will get worse. It shows us the housing market right now, it's starting to fall apart. It's starting to implode. And we can see that the real estate market was completely pumped up into these gigantic bubbles in 22 different cities. And there was a report that was released from the U.S. Treasury Department Financial Crimes Enforcement Network, FinCEN, and it announced that it's going to extend for another 180 days a temporary program that was due to expire on Thursday, that originally kicked off in January 2016, to look into money laundering in the housing market. They want to track secret home buyers who hide behind shell companies and other opaque structures for the purpose of money laundering. And the U.S. housing market has been a perfect platform to launder large amounts of money. No questions asked. Brokers, banks, and other industry professionals played along. There were no reporting requirements whatsoever. Everyone in the world knew it, and they came to launder their cash by buying expensive homes. Very interesting. And what they come to find out is that they were just buying all of these homes across the country. FinCEN found that about 30% of the transactions covered by the GTOs involve a beneficial owner or a purchaser representative that is also the subject of a previous suspicious activity report. And it's very interesting which cities this was happening in, where homes were being purchased. New York, Manhattan area, Miami, San Francisco, the Bay Area, San Mateo, Santa Clara County, San Diego, Los Angeles, Texas, San Antonio. I mean, these are the cities which are included in the Case-Shiller survey of the 22 cities. So if we step back and take a look at all of this, what do we see? Well, we know that investment companies, hedge funds, they've been purchasing thousands and thousands of homes. Now they're offloading them to smaller investors. We see that there were foreigners and other investment companies laundering money in these same areas, pumping up the bubble. Now, a couple weeks ago, we talked about the gasoline demand declining. Well, it has declined even further. And what we're seeing right now is that this is an indicator that the United States is in a recession. And this shows us that things are not going well whatsoever. And there are other troubling indicators because Bloomberg points out the recent pace of recovery in U.S. miles driven is slowing sharply. Vehicle miles traveled increased by just 0.5% year over year in December. For much of the prior 2 years, roughly coinciding with the crash in oil prices, growth had averaged more than 3%, sometimes spiking to 5%. So people are driving less and less, maybe because they don't have to go to work, maybe because they can't find a job. And what we're seeing right now is things are rapidly falling apart. And we have to remember something very important. The stock market is continually moving up on the idea that Trump is going to come out with all these different reforms. And as we talked about yesterday, well, we're not going to see these reforms till maybe later this year or maybe next year or the year after that. Once individuals start getting wind of this, guess what's going to happen to the market? Because this is all based on hope, the idea that things are coming down the pike here. So things are going to turn around dramatically. And what's very interesting is that they keep saying that, oh, the stock market, maybe it's overvalued, maybe it isn't overvalued. Well, guess what? It is overvalued. And here's why. And this is coming from sovereign man Simon Black. When we look at the stock market right now, and we look back through more than a century of financial data, the long-term average PE ratio for the S&P 500 has been about 15. As of yesterday afternoon, the PE ratio for the S&P 500 stock index reached 26.5. That's high, more than 75% higher than the long-term average. Since the 1870s, there have been a total of 3 periods in which the average stock PE ratio was above 26.5. The first time was around the panic of 1893. The second was around 2000, the dot-com crash. The third was around 2008, the financial collapse. Do you see the pattern? The pattern is when these financial markets, when they get overheated, bad things tend to happen. And it's also important to consider the economic growth worldwide has been slowing. GDP in 2016 never got over 1.6%. HSB, they just said, well, their profits have plunged 62%. Bundesbank is preparing for a collapse. UBS is saying that their credit impulse just went to negative. And then we look at something called the Buffett valuation. The Buffett valuation looks at the total value of the stock market relative to the country's GDP. Warren Buffett has called this ratio probably the best single measure of where valuations stand at any given moment. Right now, for example, the total size of the U.S. stock market, according to the Federal Reserve, is $22.6 trillion. Meanwhile, the total size of the U.S. economy is $18 trillion. This puts the Buffett valuation around 1.2, meaning the stock market is about 20% larger than the entire U.S. economy. Historically speaking, this is expensive. Stock markets start getting into trouble when the ratio surpasses 1. And where are we today? Well, we're way above that. That tells us that things are going to rapidly fall apart. And we're starting to see many patterns. The Fed index, UBS credit impulse. We are seeing the Buffett indicator. We're seeing the PE ratio is way above where it should be. We see retail contracting. We see the housing market falling apart. We're starting to realize that people are laundering money with shell companies in the cities where the bubbles are the biggest. And then we have George Soros out there. He just placed a $500 million bet. And it wasn't at the blackjack table. It wasn't at the roulette wheel. He bet against the economy, that the economy was going to crash. And we know that he's a vocal critic against Trump. And we know that he's been pushing the riots across America. And the reason why this came out is because the Financial Times earlier reported that some of the positions, including bets against Dutch banks, appeared briefly on the website on Tuesday evening. One Dutch bank in which short positions were revealed was ING, according to the Financial Times. And ING declined to comment on the bets. And the Dutch Market Authority apologized after admitting it had accidentally published details of the short positions in stocks. So he is looking at what is going on here, and he's making a bet that the economy is going to decline and crash. Now remember, these insiders know exactly what's going to happen. They know that the economy is not doing as well as everyone is saying. They know that the economy is coming down. And out of all the indicators that we've been looking at, we can definitely see a pattern, because this has happened in history going back in time. It's not like this is something new. Like, oh, look, all of a sudden, this is something new, and it might crash. No, this has happened time and time again. And every time we see the same pattern, guess what? We get the same result. And that is a collapse of the system. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.